Hello everyone, welcome to today's TA session. So today we're going to review Chapter 3, Chapter 7, and an Excel example. First, let's review Chapter 3. Chapter 3 is mainly about how we value the bonds. Question 2, about prices and yields. The following statements are true, and for option A, if a bond's coupon rate is higher than its yield to maturity, then the bond will sell for more than the face value. So in practice, when a bond's coupon rate is higher than its yield to maturity, we say it sells at a premium. The reason is mainly because if the coupon rate is higher than the yield, then investors must be expecting a decline in the capital value of the bond over its remaining life. Thus, the bond's price must be greater than its face value. Option B. If a bond's coupon rate is lower than its yield to maturity, then the bond's price will increase over its remaining maturity. In practice, we call this sell at a discount. It's vice versa as like in option A, because if the yield is greater than the coupon, the price will be below the face value and it will rise over the remaining life of the bond. Question 5. Let's construct some examples about the following cases. A. If interest rates rise, do bond prices rise or fall? This is quite classical that when interest rates rise, the bond prices will fall. A simple example is as follows. Assume a 1-year 10% coupon bond. If the interest rate is 10%, the bond is worth 110 over 1.1, and the price will be 100. So we can see that when the coupon rate is equal to the interest rate, the bond will sell at par. If the interest rate rises to 15%, the bond is worth 110 over 1.15, and the price will be 95.65. So the bond is sold at a discount when the coupon rate is lower than the interest rate. B. If the bond yield is greater than the coupon, is the price of the bond greater or less than 100? Just now we show that it will be less than 100. C. If the price of a bond exceeds 100, is the yield greater or less than the coupon? If the price of a bond exceeds 100, we call that the bond is sold at a premium. So the yield must be less than the coupon. Example will be with the yield at 5%. The 1-year 10% coupon bond is worth 110 over 1.05, and the price is at 104.76. D. Do high coupon bonds sell at higher or lower prices than low coupon bonds? If a bond has a higher coupon, then it must sell at a higher price, given the interest rate is the same in the market. A simple example would be if the interest rate is fixed at 10%, a 1-year 10% coupon bond is worth 110 over 1.1 equals 100. The price is 100. While a 1-year 8% coupon bond is worth 108 over 1.1 equals 98.18. So the higher coupon bonds sell at a higher price than lower coupon bonds. E. If interest rates change, does the price of high coupon bonds change proportionately more than that of low coupon bonds? This is an interesting question because in practice, we always use duration to see the relationship between interest rate and the price of the bond. So the answer is no, because low coupon bonds have longer durations. Well, unless there is only one period to maturity and are therefore more volatile. Notice that when a bond has longer durations, the bond price will have higher sensitivity to interest rate change. For example, if interest rate falls from 10% to 5%, the value of a 2-year 10% coupon bond rises from 100 to 109.3, while the value of a 2-year 5% coupon bond rises from 91.3 to 100. So we can see that the lower coupon bond has longer duration, thus it has higher sensitivity to interest rate change. You can look up the different formulas of calculating durations in the book, and the simple reason for lower coupon bonds have higher durations is that in the formula, the numerator is greater than the denominator, and the coupon, if the coupon is lower, you can see that the fraction will be higher as the bond's duration. I'm sorry. Question 11. Duration. Question A. Longer maturity bonds necessarily have longer durations. The answer is false. We just show that the duration depends on the coupon as well as the maturity. Question B. The longer a bond duration, the lower its volatility. The answer is false. We just show in the last question that if a bond has a longer duration, its volatility will be higher. So given the yield to maturity, volatility is proportional to duration. Question C. Other things equal, the lower the bond coupon, the higher its volatility. True. Answer is true. We just show that a lower coupon rate means longer duration and therefore higher volatility. Question D. If interest rates rise, bond durations rise also. The answer is false, because a higher interest rate reduces the relative present value of distant principal repayments. So we can refer to the duration formula. We can see that a higher interest rate will cause the numerator to decrease very fast. So the duration will be smaller. So if interest rates rise, bond duration will decrease. Question 15. Prices and yields. A 10-year German government bond has a face value of 100 euro and a coupon rate of 5% paid annually. Assume that the interest rate in euros is equal to 6% per year. What is the bond's present value? So to calculate the present value, we have to discount the future cash flows and principal repayment. So this part is the coupon cash flow, and we can discount using the formula in the book. And this part is the present value of the principal repayment. And the answer is 92.64 euros. The calculation is quite simple, but we have to always pay attention to this part. We have to check carefully if it pays the coupon annually or semi-annually. Question 17. Prices and yields. A 6-year government bond makes annual coupon repayments of 5% and offers a yield of 3% annually compounded. Suppose that 1 year later the bond still yields 3%. What return has the bondholder earned over the 12-month period? Now suppose that the bond yields 2% at the end of the year. What return would the bondholder earn in this case? So in this question, when we have to calculate the bondholder's return, we just need to calculate the present values in different years, and we can show that in the following calculation. So if we purchase the purchase price for a 6-year government bond with 5% annual coupon would be, this is the coupon. Notice that a U.S. government bond, the face value for U.S. government bond, the face value would be $1,000 instead of 100 euros as we see in the last question. So with a coupon rate of 5%, the coupon would be $50. And using this discount factors formula, and this is the principal repayment, $1,000, and we discount it to today. So the price would be 1,108.34. Using the similar calculation, the price 1 year later is equal to the present value of the remaining 5 years of the bond. This is also the coupon, discount factor, principal repayment, and this is the price. So the rate of return would be, if we buy it today with 1,108.34 and sell it at this price. If we buy at this price and sell at this price, and we add the coupon, and this is our investment, so the rate of return would be 3%. But if the interest rate in the market, well, the yield drops to 2%, we can see that the price next year would be, this is the coupon, the discount factor, principal repayment, and the price would be 1,141.4. It would be much higher than this one. So the rate of return would be, this is our sale price, this is our investment, and this is the coupon. And this is our investment. The rate of return would be 7.49%. So much higher than in this case. So in other words, we can see that if the interest rate drops, the price of the bond will rise. Question 20, spot interest rates and yields. So we now have got 5 different interest rates for 5 different years. And these are the spot interest rates. So in standing at different years, if we are standing at year 1, the discount factor would be 1 over 1.05. If we are looking at year 2, the discount factor would be 1 over, using this as the discount interest rate. So it would be 1.054 square. Year 3, using the similar argument. Year 4, similar calculation. Year 5, all the same. And for the forward rate, we can think like this. If we are standing at year 1 and we're looking at year 2, and then we're standing at year 2 looking at year 3, so the forward rate would be the discount factor, the ratio of discount factor in different years minus 1. So the calculation is really simple. Question B. Calculate the present value of the following bonds assuming annual coupons. 1. 5% 2-year bond, and 2. 5% 5-year bond. So using the same calculation as in previous problem, we can see that this is the coupon, the repayment, and the last year's coupon and discount factor. And this is for the 5-year bond, each year's coupon, and the last year principal repayment plus the coupon. For the 2-year bond, the price is 992.79, and for the 5-year bond, the price is 959.34. Then let's come to chapter 7. This is a chapter introduce you to the risk and return, mainly about the portfolio choice theory by Harry Markowitz and mean variance formula. Question 4. Portfolio risk. A. Investors prefer diversified companies because they are less risky. This is certainly false, because investors prefer diversified portfolios, mainly because diversification reduces variability and therefore reduces risk. But it has nothing to do with an individual company if it's diversified or not. B. If stocks were perfectly positively correlated, diversification would not reduce risk. This is true, because if the co-movement are in the same direction, there is no reason for us to invest in both stocks. C. Diversification over a large number of assets completely eliminates risk. This is not true. Because the risk eliminated by diversification is called specific risk, or the risk surrounding an individual company or industry. There will always remain some risk, however, called the market risk, like the 2008 financial crisis. It's also called the systemic risk. That is present when investing, like in any assets. D. Diversification works only when assets are uncorrelated. This is not true. It's true that the greatest benefit to diversification occurs when stocks are uncorrelated. However, most stocks tend to move in the same direction. There are still benefits to diversification when stocks are slightly correlated. Well, there are some good cases when stocks are negatively correlated, and we call the stocks each other a hedge. E. A stock with a low standard deviation always contributes less to portfolio risk than a stock with a higher standard deviation. This is not true, because the contribution to portfolio risk depends on the relationship of the stock to the market as a whole. We call it beta. F. The contribution of a stock to the risk of a well-diversified portfolio depends on its market risk. Well, this is true. That is the coefficient beta. G. A well-diversified portfolio with a beta of 2.0 is twice as risky as the market portfolio. This is true. H. An undiversified portfolio with a beta of 2.0 is less than twice as risky as the market portfolio. This is not true. As the beta is 2.0, it's still twice as risky as the market portfolio. Question 5. Diversification. In which of the following situations would you get the largest reduction in risk by spreading your investment across two stocks? A. The two shares are perfectly correlated. B. There is no correlation. C. There is modest negative correlation. D. There is perfect negative correlation. The answer is D, because this strategy does the most to reduce risks because the stocks move in opposite directions. In other words, they are a perfect hedge. When one goes up, the other goes down, and vice versa. This does the most to reduce risk in a portfolio. Question 14, portfolio risk. So the guy invests 60% of her funds. The lady invests 60% of her funds in stock 1 and the balance in stock J. The standard deviation of returns on I is 10% and on J it is 20%. So we need to calculate the variance of portfolio returns, assuming A, the correlation between the returns is 1, B, in another case, the correlation is 0.5, C, another case, the correlation is 0. So the share in two stocks is 60% and 40%, 60% in I and 40% in J. And the standard deviation for stock I is sigma I. Sigma I is 10% and sigma J is 20%. So using the variance portfolio in the book, these are all the same. This is the share standard deviation, and the cross term. Notice that there is a correlation, coefficient of correlation in it. This is rho. So we plug in the numbers, and here we plug in the correlation between the two stocks is 1. And here we plug in 0.5. And in C, we plug in 0. And we can get that when the positive correlation is bigger, the risk of our portfolio becomes bigger. We can see that the higher the correlation, the bigger variance of the portfolio. In other words, the higher risk of a portfolio. Question 21, portfolio risk. Here are some historical data on the risk characteristics of Dell and McDonald's. So the beta coefficient is 1.25 and 0.45. And the sigma is 32.4 for Dell and 14 for McDonald's. Question A. The correlation coefficient of Dell's return versus McDonald's is 0.48. What is the standard deviation of a portfolio invested in half in Dell and half in McDonald's? So using the same formula, we plug in the share of our investment, the risk parameter, share risk, and this is the coefficient of correlation. And we can get, this is half in Dell, half in McDonald's, and this is the correlation coefficient. And we can get the variance is 420. So we take the square root of the variance, we get the standard deviation is 20%. Let's come to the Excel practice. So the spreadsheet in the Excel is quite powerful when we are valuing bonds. Here is a quite useful function called price. It has the following parameters in this function. The first is the yield to maturity, and the second is duration, and modified duration because we have like other formulas of calculating duration. And settlement is the date that you buy or sell the security. Maturity is the maturity date. You can enter the date like in this formula. So let's try this. Let's try the first. In February 2009, Treasury 8.5% coupon semi-annually of 20 maturing in year 2020 yielded 3.2976%. What was their price? Let's see. So we set a transaction date. Say it's in February, so we can name a random day like, for example, if we buy at February the 15th in 2009, and the maturity date is February the 15th, year 2020, and the coupon rate is 8.5%, and yield to maturity is 3.2976%, and we get paid back in full. Notice that the default setting in Excel is 100, but the Treasury bill is 1,000. But we can always set the redemption value equal to the principal value. And the frequency is 2 for semi-annually, 1 for annual payments. So Excel gives us the current price, if we buy it, would be 147. Now if the yield rises to 4%, we can expect what? If the interest rate rises, the bond price will fall. So we can see that the price falls from 147 to 139. It's pretty straightforward. You can try it on your computer. And for 2, 3, and 4, you can always use this dialog, use this window to finish them. Hope this helps in your study and in future practice. So everybody, that's all for this TA session. Thank you. Have a great day.